Patent valuation. We are going to consider here how we can evaluate patents from an economic and financial view. This video presentation is taken from my book, The Valuation of Digital Intangibles, published by Palgrave Macmillan. Now we consider which is the link between patents and more general intangibles. And we can say for a definition that a patent is a non-monetary intangible that is going to manifest itself by its economic properties. It is a non-monetary because it is not represented by cash or liquidity. And being an intangible, an immaterial asset, does not have any physical substance, but the patent is going to grant rights and economic benefits to its owner. Intangibles are in general more specific than other tangible assets, and they incorporate higher information asymmetries. These are due to the higher risk profile and the lower collateral value. In other words, intangibles are more difficult to detect and to assess, and for that very reason, they tend to have a value that is significant and meaningful during a going concern scenario, but can approach even zero when we go to a breakup value, when the company is not able to work and function anymore. The accounting recording of intangibles and also of patents is highly controversial, and it is going to privilege prudence over substance. You can have a reference to another file and PDF presentation for the general valuation of intangibles. Now, we can also say that patents are the result of risky and costly research and development. And the developer of the patent will try to recover its cost and possibly earn a positive return through the sale of products that are covered and protected by the patent. And these products can be either licensed to other people or sold in a definitive way. Patents are typically registered for protection, and they are valued for litigation or licensing purposes. Even when there is a litigation, the value of the patent can emerge as a result of discussions within the court. Patents can create a scalable value, a value that can grow even very quickly. And this is due to the fact that being an intangible asset, a patent is a non-rival good. What does it mean? If you own a sandwich, this is a rival good. Either you eat the sandwich or somebody else does. If you have a patent, you can exploit it simultaneously in many, many different ways, and this can be done by an infinite number of people. For that very reason, the patent is scalable and can create a very high increase of value. Operating leverage that is represented by the marginality that accrues inside the EBIT, the earning before interest and taxes, due to an increase in the operating sales of the company, is enhanced by patent-driven scalability. And this has a positive impact on cash generation. Why is it the case? This happens because if I increase the sales, I have an increase on the operating profit represented by the EBIT. This increase can be, for example, even more than proportional, especially if I have a high percentage of fixed cost, and especially if there are scalable items such as patents. If EBIT grows, normally even EBITDA grows, and the difference between the two accounting concepts is represented by depreciation and amortization. Operating profit or EBIT plus depreciation plus amortization of intangibles like patents corresponds to EBITDA. And earning before interest, taxes, depreciation, and amortization is going to represent that cash that is generated if the parameter is positive by the income statement of the company. For that very reason, if there is a scalability that is going to increase the EBIT, also the EBITDA is going to increase, and this is going to produce a positive liquidity for the company. This positive liquidity is going to be estimated and assessed, and this is a key parameter for the appraisal of the patent. Now we can have a definition represented by the OECD guidelines for transfer pricing, and they distinguish between what we can say commercial intangibles like patents and marketing intangibles, for instance, related to trademarks. Patents obviously represent the natural evolution of know-how. Know-how and trade secrets are proprietary information or knowledge that assists or improves a commercial activity, but that is not registered for protection in the manner of a patent or trademark. What does it mean? It means that I can have a trade secret know-how that is not patented, is not protected against copy from outside people, unless this is due to unfair competition, but it is more difficult to demonstrate in court in a litigation case. If I have a patent, on the other side, I have to describe the contents of my invention, and that may be a trick because other people from outside can understand the basics of the patent, and it is easier to copy it. So there is a sort of trade-off. A patent can be copied more easily than no internal know-how, but on the other side, a patent can be protected. Let's make an example. There is the formula of the chemical composition of Coca-Cola. This formula has never been patented. It is an industrial secret within the company, and it is going to remain this-like for the rest of the life of the company. A patent valuation is required in many cases, and as mergers and acquisition operations, spin-offs, demergers, joint ventures, in bankruptcy, when the patent might still have a small collateral value, for sale or license, for conflicts or disputes regarding patents, as a collateral for bank loans, for accounting, or even for taxation. Concerning in particular the collateral for bank loans, there is a sort of paradox. From one side, we can say that banks never love to lend money to companies whose assets are not represented by fixed intangible assets that can be used as a collateral. Let's make an example. I am a bank. I want to lend money to a company. If the company has a real estate property, I can put a mortgage on it. I can have a physical guarantee on the asset of the company. If there is an intangible asset, it is more difficult to have a guarantee. And from this side, patents are much better than know-how because they are recorded. They can be opposed to third parties that try to copy them. And so they might still have a collateral value, maybe small but still tangible. On the other side, even if banks do not like intangibles because they don't have a real collateral value, intangibles are the major drivers of growth and are cash generating items. With a patent, I can generate more liquidity, and if this is the case, it is easier to pay back debt, generating cash to serve it. Now, there is a trade-off between license or sales. A license of a patent is going to contain some or all of the following financial provisions: upfront payments to the patent owner, ongoing pre-commercial payments, a patent cost reimbursement, milestone payments when an event occurs, then the payment is done, annual minimum royalties, a research support, a sublicense income sharing, a revenue from manufacturing, or earned royalties or sales, or even profit sharing. The royalty is normally based in terms of net sales and can be based on the money value of the sales of the product or a royalty fee based on the units of product sold. Now we have to consider the accounting value of patents that is a prerequisite for the financial and economic evaluation of the patent. As we have already anticipated, patents are an ongoing challenge for accountants like the other intangibles. And the main concept is this: intangible value is typically hidden in the balance sheet by inadequate accounting for prudentiality reasons, but this is not the case neither in the income nor in the cash flow statement, where the intangible and the patent contribution to profit can be fully detected. As the patents are non-monetary assets, they are non-monetary and non-physical assets, it is difficult to find a real evidence for their very existence. Intangible assets may be recorded as an asset in the balance sheet in the assets only if future economic benefits can be really expected and proved. An intangible asset can be identified if it is separable or if it arises from contractual or other legal rights. This is also according to the International Accounting Standards 38 that is dedicated to intangibles. I should identify an intangible and so also a patent if it is different from the internally generated goodwill that can never be recorded, again for prudentiality reasons. According to Baruch Lev of NYU, we can say that most of the strategic value-creating resources of the business, such as patents, IT, or brands, are currently expensed in the income statement, and so they are not recognized as assets in the financial reports, in the balance sheet. They are not capitalized. And this is going to understate the earnings and assets of intangible growing firms, patent-intensive firms, and this is also going, on the other side, to overstate the earnings and assets of intangible declining firms. The disclosure of intangible expenditures, even concerning patents, in financial reports is seriously deficient. Except for research and development, all other intangible expenditures are generally aggregated within large expense items, within the monetary OPEX, monetary operating expenditure, mainly within the cost of sales and selling general and administrative expenses. Now we can see the main valuation picture according to the International Valuation Standard 210 that is dedicated to intangibles. We can have a patent. A patent is linked to know-how, and we can have an exclusive right to use an invention. The main approaches according to International Valuation Standard 210 are the cost-based approaches, the income approaches, or the market approaches. They can be linked to relief from royalties, discounted cash flows, comparability factors, or even real options. And the purposes of valuation may concern the estimate, the assessment of the fair market value, the investment value, the intrinsic value of the patent, or even the breakup or liquidation value if the company is not going to run with a going concern perspective. Now we have a comprehensive representation of the integrated equity, economic, financial, and empirical and market valuation, the main valuation methodologies applied to patents. We have here in the first part of the graph a comprehensive picture of the balance sheet with assets and liabilities, the income statement or profit and loss account, and eventually the cash flow statement. From an accounting perspective, we can say that we can calculate the cash flow statement considering the differences, the variance in the balance sheet, a balance sheet of this year compared to the balance sheet of the previous year. Then we can match this difference in the balance sheet with the income statement of the last year, and eventually we can derive the cash flow statement. We can have a valuation with income methods from the income statement, financial methodologies deriving from the cash flow statement, or a balance sheet based approach deriving from the balance sheet from the assets and liabilities of the company. Now, again, according to the International Valuation Standard 210, we can have, as we anticipated, the three main valuation approaches: the income approach, the market approach, and the cost approach. Let's going to consider a comprehensive picture of these three approaches. The market approach can be linked to enterprise value divided by the EBITDA. Enterprise value is going to represent the market value of the whole company. I mean, the market value of the equity belonging to the shareholders, but also considering the financial leverage of the company, also considering the market value of debt. So this is the total value of the company. From the enterprise value, we can go to the equity value if we subtract the net financial position, or we might add it if it is positive. If we divide the enterprise value by the EBITDA, we can understand which is a major multiplier normally used within the market approach. And we can also consider the weighted average cost of capital to discount operating cash flows. And this is the cash flow statement. Or we can have a cost approach derived from the income statement, or even an income approach, again inspired by the income statement and linked to many valuation methodologies: relief from royalties, incremental or differential income, with or without, which is the value without or with the patent, a price premium, and other methodologies that we're going to see in the next slides. Let's consider the cost approach. This approach is possible according to the International Valuation Standards 210, but is not the main one. According to the cost approach, the value of an intangible asset, of a patent, can be assessed by the sum of the capitalized cost to be incurred to reproduce it. Let's say that I don't have any patent. Which would be the cost to produce and to create the patent from scratch? There is also a concept of time opportunity that is typically not considered in this kind of cost approach. It is difficult, however, to find cost incurred in the past. And so the replacement or reproduction cost is not easy to assess. This kind of cost approach can be used, for instance, with software. And software in continental Europe is legally represented by copyright legislation, whether in the US it is typically linked to patent legislation. So there is a different approach, and we can compare software to patents, especially in the US. We can also have an income or financial approach. Why can we link income to financial flows? Because we can have economic margins that can be linked to financial margins. For instance, EBITDA, earning before interest, tax, depreciation, and amortization of intangibles like patents, is at the same time not only an economic margin, but also a financial margin. The income approach is going to convert future cash flows to a discounted present value, which is the value estimated today of future cash flows, and how can we discount this to get a present value. We can use, for instance, a relief from royalty approach. The question behind this methodology is very simple. Let's say that I don't have any patent. Should I rent a patent with a license agreement? How much would I pay? This is the question. Let's say that the patent is going to produce average sales of 100. Let's say that the royalty rate is 5%. I would pay 5 per year. And this is a good indication of the possible value of the patent. I can also have a with or without approach. Let's say that the value of the company without the patent is 100, and the value of the firm, including the patent, is 180. The incremental value due to the patent is 80, and this is also a further indication, a complementary one, of the estimated value of the patent. We might also have, in the income financial approach, the excess earnings approach to be used forecasting the amount of the future revenues driven by the patent, forecasting the expenses of the patent, and adjusting the expenses to exclude those related to the creation of new patents. This is an alternative way to calculate, to estimate the value of the patent, again according to the international valuation standards. We might also use the greenfield approach, using cash flow projections, the distributor approach, similar to the relief from royalty approach, or real options. Real options are often used for patents, and they can estimate, evaluate flexible investment projects with uncertain outcomes. Real options are a fundamental characteristic of scalable investments. They can refer to the option to expand a production, to put it off, to suspend it, to abandon it. And they can make net present value and internal rate of return calculation within the capital budgeting more flexible, because they incorporate in the future estimated cash flows the possibility that things are going to change and to adapt to be resilient to the external world. Or we can also discount differential or incremental income or cash flows due to the use of the patent. We might have, after the cost and the income approach, the market approach, again according to the International Valuation Standard 210. The market approach is going to consider the prices and other relevant information generated by market transactions. And according to the International Accounting Standard 38, there is a very important warning, according to which an active market cannot exist for brands, for patents, etc. So there is no active market. It is difficult to make a comparison. And this is an intrinsic characteristic, especially concerning patents, even more than trademarks. Unicity is a factor of strength, but also a weakness. Let's say that my patent is unique. If the invention is unique, it might be patented. If it isn't, it is difficult to file for registration of an invention that is not original. But if the invention is original, then it is also difficult to compare it. So this is a very hot issue, and this issue is going to be important either for transfer pricing considerations. Now we can have some approaches, an empirical approach using a coefficient of the strategic strength of the asset. I can have a valuation of incremental assets using, for example, the Tobin Q, which is going to compare the market value of the activities of a company to the replacement value. If the Tobin 2 is higher than 1, there is a presence of an implicit goodwill that might be referring to the presence of the patent. There is also a price book value index, again, if it is higher than 1, so this means that it might include an implicit valuation of the patent. And eventually, we are going to consider some references. This lecture is taken from my book, The Valuation of Digital Intangibles. This is the website reference to the book. You can find a copy of this PDF file in a paper published on ResearchGate.